Hi there. Today we're talking about the various types of life insurance for working individuals and families, and we're going to do this in 5 minutes or less. This is financial advisor Chuck Wynn, based out of Menominee Falls, Wisconsin. There are three types of life insurance policies: term insurance, whole life insurance, and hybrid life insurance, or a combination of both. The way the policy works is an owner of the life insurance policy pays a premium to the life insurance company. Then the life insurance company pays a death benefit to the beneficiary upon the death of the insured life. Term insurance is the simplest type of insurance. It is also the most affordable. Term insurance should also be called temporary insurance because it is in force for a specific period of time, from 10 to 30 years. The premium is set and never changes for the length of the policy. The great news about term life insurance is, one, it's affordable coverage. The bad news, if your health declines, you may be ineligible for additional coverage. There's also a return of premium type benefit for certain policies that will give you all of what you paid into it if you want to cancel the policy. Be sure to check with your carrier to make sure the policy carries that optional rider. The second type of policy is whole life insurance. Whole life insurance is a permanent form of insurance. As long as premiums are paid, the death benefit will be protected. An added benefit is the cash value portion of the policy. When paying more than the premium, the extra premium will grow inside of the cash value bucket of the policy. The good news about whole life insurance is if your health deteriorates, additional coverage may still be obtained. The bad news is the cost is generally much higher than on a term policy because of these added features. The third type of life insurance is of a hybrid form. Universal life, variable universal life, and index universal life are all forms of hybrid life insurance policies. With a hybrid life insurance policy, the policy cash values can be invested to obtain higher rates of return. By investing your cash value, you should expect a higher growth rate, which could lower the cost of future insurance premiums. But please keep in mind, with greater return or on the expected growth of your cash value also exposes you to greater risk associated with these policies. So you really want to work with a good financial advisor on picking how your cash value is invested within your life insurance. The two biggest reasons people buy life insurance is to protect their income and pay off their debt in the event of an unexpected death. The death of a loved one, though heartbreaking, can be financially devastating as well. The family could be left to replace income from an income earner or to pay the debt from student loans, credit cards, or negative home equity. If you're in this category, you certainly want to explore life insurance as an option. Let's look at an example of a common family. Husband earns $100,000, wife manages the home with no income. What if the husband dies? How will the wife be able to continue to manage the home? Or what if the wife died earlier than they expected? How will the husband continue to manage the home if he's expected to earn that same level of income? Though life insurance can't bring your loved one back, it can ease the financial burden for this family. A $500,000 life insurance policy could provide either spouse 5 years of continued income, at least. The second example is where both husband and wife are working and earn $30,000 each. They have credit card debt of $20,000 and their home is worth $100,000, but their mortgage is worth more than their house by $30,000. If either spouse dies before expected, the other will most likely have to cover the total debt. An inexpensive $100,000 life insurance policy could easily pay the $50,000 of debt and provide at least a year of income to the survivor. All right, so you've determined you want to buy some life insurance. The steps to follow start with determining the goal. Is it to maximize the death benefit value that goes to the beneficiary? Or is it to kind of both, a retirement savings strategy and a death benefit combination? Once you determine your goals, then establish the amount of death benefit needed. Then simply compare the premiums and choose the best policy. Now you know most of what there is to know about life insurance for working people and young families, and you figured all this stuff out in less than 5 minutes.